The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we found a solid, strong move to the upside in the cattle trade and hogs too on Tuesday, while the grains and oilseeds were under some pressure, led lower by Chicago and KC wheat futures and by soybean oil. Corn and soybeans themselves down just a little bit. We got producer price index data out on Tuesday, the CPI report coming up on Wednesday, and we got other news headlines to talk about in these markets. A lot to go through. Let's dive into it. Joining us for a conversation, Tyler Schau with agmarket.net. Tyler, welcome back to Market Talk. Hope you're doing well, my friend.
Doing good. Good to be back on visiting with you.
And as I indicated, a lot for us to talk about here, Tyler. I know these grain markets, we'll start there. Of course, we got the WASDE numbers that last Friday, kind of got those digested. We got crop progress numbers on Monday afternoon. We've kind of digested those. Largely, it just, you and I were talking about this before we went on the air. A lot of points here where it's felt like farmer selling has kind of just sucked some life out of this rally here. I think that was evidenced on Tuesday's trade. What do you think?
Yeah, I think over the last week, we've seen a lot of farmer selling on these rallies. You know, there's a lot of talk yesterday, over the weekend, and then continued yesterday with the managed money positions. And, you know, we've been hammering on this for seemed like months now, how the managed money crowd had a very large short position. They typically don't carry that short position in through the planting and the big weather, season here for U.S. crops. And so we've been waiting on it, but the caveat has always been the farmer's sitting on a lot of grain that is unpriced. And so if these managed money funds come in and start buying back their futures positions, it's probably going to be, not completely, but somewhat offset by farmer selling. And so that's why we've seen that big unwind of that managed money. Like you take corn, for example. I think last Friday's commitment of traders report was one of the 5th largest buying sprees that managed money had gone on since the report began on a week over week basis. We see corn up 30-40 cents from the lows just a couple months ago. So it's been good. It's provided us those opportunities, but we're right up there at some of those sale targets. You know, a lot of people on new crop corn have been really hunting for that 497 to 504 from that gap that we created there from last trading day of December to first trading day of January. So we know there's a lot of people with orders working to sell up there. And if you take a look, December corn hit 496 and a quarter today and ended up settling down at 491.
Well, and I'm going to ask you this. I've asked a few people, and I'd love your perspective on this. 491 D's corn, people look at it kind of that, we'll call it that $5 mark to really make some new crop sales. I mean, is it necessarily a bad thing to get yourself protected or even make a sale? Let's say it's at 495, 496. I mean, is it a bad thing to give up a couple of cents here? I know it's different for everybody, and some people might laugh at me when I say that, but I mean, is it really all that much to fret about over 2 or 3 cents?
One of the comments I'll make quite often to my customers is sometimes we worry about pennies and lose dollars. And so, that's kind of my thinking there. If that tells anything, if we know that 497 mark is going to offer quite a bit of selling because of a gap on a chart or some other technical signal that might be out there, say it's a moving average that we've struggled getting through. I try to push customers to put my order in a few cents below that, try to beat the trade. When I first started working 4 or 5 years ago in this industry, the mantra was try to beat it by, a half a penny to 3/4 of a penny. And it just seems like every year with the way this market can move and move big and move away from a target awfully fast, seems like, that 2, 3, and sometimes even 4 cents is where these orders are being piled in at. So if you're behind, if you got nothing done, we've got some people calling in that are asking, I don't have anything done on new crop. By all means, 490 is not a bad place to start.
No, that's a good way to put it. I would agree with you there. 490 is not a bad place to start here, especially with the way these markets have been and how volatile things have been. I think farmers selling too in the wheat markets, as well as Chicago KC were the downside leaders Tuesday. Spring wheat held up okay. And, I look at that planting pace on spring wheat as well. I mean, we are well ahead of our averages here in spring wheat country. And I know you're in North Dakota. I mean, I just felt like, especially in the case of Chicago and KC wheat, we kind of kissed that $7 mark. And that just led to a lot of sell action there, Tyler.
Yeah, there was some selling come in. A lot of that rally from yesterday was on the news that came out of Russia. They've had, they've been dry, they've had some cold, in some places colder than a lot of people thought. One of the problems with frost damage or freeze damage in wheat is, it's going to take some time to figure out what type. We might not know what type of damage it did until it's harvested, and then on top of that is Russia, so we may never know what type of damage was done at the end of the day. And I think the market, you got some of that headline risk, pushed it higher. Market kind of stepped back and said, Russia is still sitting on big stocks of wheat. For the last 4 years, they've grown big crops. A smaller crop this year is probably not the end of the world. Now there are some, there are some fundamental reasons in this wheat market why we've pushed higher. Add to that the massive short that managed money had in all wheat classes has kind of fueled this fire. But we've been pushing producers up here anyhow to take a look at making some sales. We were sellers at $7 September spring wheat. We made some more sales today when we hit 745, and yesterday as well. So I mean, we like taking advantage of these rallies, and wheat's wheat. Wheat's going to do wheat things, and sometimes it'll give you the impression that it's just going to continue going higher for the next several weeks. And there again, that idea of sometimes we worry about pennies and lose dollars. We can knock a dollar off the wheat market in a couple trading days. So we're trying to be proactive here and start making some sales on new crop. We do like to keep a little old crop in the bin, especially for any type of summertime drought conditions. So we're holding off on our last chunk of old crop, but we're starting to get into some tranches of new crop sales.
Tyler, I want to talk to you about soybeans, and I got a couple things swirling around my brain here when it comes to the soy complex, kind of tying with that old adage of worry about losing pennies and losing dollars that you like to use. Especially Novi beans, right above that 12 mark. When I think about this soy complex right now, though, there's a few things that concern me. One is I know we saw CONAB, they came out with a higher Brazilian soybean estimate, even with the flooding issues in Rio Grande do Sul. So that's one. And then two, these tariffs, the increase in tariffs by the Biden administration on China. And anytime I think tariffs on China, I think soybeans and retaliatory tariffs. And so those are a couple things together that really concern me. Plus just the fact we got a lot of soybeans on hand here, Tyler.
Yeah, the WASDE report on Friday was not exactly bullish soybeans from a U.S. standpoint or from a world standpoint. If Brazil does come in and have a really good growing season, just the amount of acres they brought into production could push them north of 180 million metric ton of soybeans next year, which is just a behemoth of an amount of soybeans that we're going to have to chew through. Talking about the increased acres, that's really where CONAB's increase in their estimates came from. They did lower some of the yield just with the flooding going on, but the increase was pretty much due to higher acres, which has been the USDA's argument really for the last several months when they released their estimates out of Brazil. And they've got at one point they were 8, 9, 10 million metric ton higher than CONAB. And the USDA's argument was the acreage size had grown. So with that increase by CONAB, it actually pulled that spread between the two to like 7 million metric tons. It's getting a little bit closer. So, maybe the USDA doesn't have to pull that number down much. You mentioned the tariffs. There was some talk that we would see a tariff on used cooking oil, because that's one of the things that's really been going on. Chinese are shipping, quote unquote, used cooking oil. How do we know that it's used cooking oil and not just palm oil with French fry dropped into it, into the U.S. and taking advantage of that subsidy for biodiesel or renewable diesel? And so there was some talk that, or some rumors floating around that there was going to be, they were going to throw in a tariff on used cooking oil. That was not in those tariffs. So I think that was number one. One of the reasons soybean oil is down so hard today. And then number two, like you said, now the market's starting to look and go, okay, is China going to retaliate, which they have publicly stated they would, and maybe that retaliation comes in the form of not buying any soybeans, which on the one hand is negative headline, but on the other hand, our new crop book of business to China on soybeans is pretty pathetic right now. So.
We are talking today with Tyler Shao from agmarket.net here. And Tyler, just kind of wrapping up that China point there with the tariffs. And you hit the nail on the head, of course. I mean, our soybean exports to China are just dismal at this point in time. They're getting a lot from South America. And there's the risk, too, they could put tariffs on other commodities that we have to keep an eye on. But I just wonder in the backdrop of we hear about tariffs, then we got this pesky inflation environment hanging around. They got the producer price index data out Tuesday, a little hotter than expected, up 0.5% month on month. Consumer price index data out Wednesday. I mean, you think about things with tariffs and people are talking about high food prices. President Biden saying, yeah, they're higher, but people got the money to spend. Just all these things together makes me a little uneasy watching some of these markets. And I think that kind of brings me back to the whole idea of managing your risk right now just to be safe, right?
Yeah, I think that's one thing we talk a lot about. Use these rallies we've seen in these grain markets. If you don't want to sell it, buy some put options, stick a floor under this thing, do something to protect. I mean, I'll be right honest. The other guy in my office and myself today, we're talking about soybeans. We're probably like every other marketing analyst or commodity broker out there. We would love to see November beans go back to that 1240 again. There's a gap up at the 1240 area from the end of December to the first trading day of January. The comment we made is probably everyone and their dog are looking for November beans to go back to that level. Maybe we need to be sneaking in here and getting a little more aggressive. We've got some protection on soybeans, probably not as much as I'd like, because just looking at the numbers, all that stuff we've talked about, whether it's inflation, whether it's the balance sheet the USDA gave us in the WASDE report last week, whether it's looking at Brazil's production next year, there's just not a lot of bullish headlines on the horizon when it comes to soybeans right now. So it's probably something we need to be getting a little more aggressive on, because same thing as wheat. Wheat, I said, can give up $1 pretty fast. Soybeans can do it in a day if it wants to.
Yeah, very, very true. Well, and I will say this, we held in that $11 range in beans a lot longer than I thought the market would. So it's nice to get back above 12 here, but again, it could fall apart pretty quick. Now, let's flip over to the proteins. Cattle had a really strong day Tuesday. Monday, I was a little nervous because we started higher and that faded by the close, but then strong gains Tuesday in both fats and feeders. The midday box beef cutout was sharply higher. I don't know. Is summer grilling demand maybe finally pick it up here in the beef side, Tyler? What do you think?
That's what it feels like. The demand is out there. The supply, we know supply is going to be an issue. We've been talking about that for what seems like a year and a half now, maybe longer. The numbers just aren't there. We've been kind of making up for some of that supply issue through heavier weights, and I think that heavier weights they rose, and they rose fairly significantly, fairly quickly here over the last couple months. And I think that just kind of caught the market off guard, and that's what it started paying a lot of attention to. That box beef price was coming down with that increase in production week over week. And now maybe we're starting to see that demand is still there. People are still going out and buying it. It could be a response to a lighter kill. I haven't really got to dive into the numbers here too closely here the last couple of days on the fat cattle side, but nonetheless it's a good pop. We got over some major moving averages in the cattle market that we've been struggling to get over. The 10-day was one on feeder cattle we haven't been able to pop up over for several trading days. Got to close up above the 10-day and the 20-day, pushing up against the 50 and the 100-day on fat cattle. So, I mean, we've got through some technical areas that were pretty significant. That probably fueled this buying. But for the most part, that's the only piece of news. We were up $3 or $4 on the cutout yesterday on choice, and then like I said, midday we were up another $3 or $4 a day. So adding on to it, back above $300 for the first time in several weeks. That's a good sign for the cattle market. Demand is there. Kind of pound on a topic we talked on earlier. Be really interesting to see where the CPI is at tomorrow. That's one of my fears with the cattle market is how long does a consumer continue forking out the money for expensive beef?
Well, I think I'm glad you mentioned that because if we see a bad CPI number on Wednesday, I have to wonder if that could send this cattle market right back down and just continue this up and down volatility here in the futures trade, especially. I know the futures and cash have been a little disconnected here in recent weeks, but yeah, if we see a bad CPI number, I think that could hamper the cattle market and too could hamper the hogs. I mean, we had a decent rally in hogs Tuesday, but their case in point, consumer demand, we're looking for that too. So, kind of tie that all together there, Tyler. It'll be interesting to see what the CPI has to tell us on Wednesday.
It will be. I think the protein market, the cattle market especially, is really bouncing around between two forces. The one is, like I said, we've got tight numbers. We've known that. That's not going to change anytime soon. It's probably going to get even tighter. We're not holding heifers back at any significant rate to replace the herd. And if that happens, now all of a sudden your numbers that are going into feedlots get even smaller, which cuts supply even more. So we still got that on the horizon. Maybe we never significantly retain heifers. We'll have to kind of wait and see. So that's the bullish push there. Kind of that headline that's out there that's holding this market afloat. The negative is all the other stuff we've talked about. What does the economy do? When does another negative headline hit about some type of a disease issue that sends this market flailing? So you've just got some coiling in here in this mid 250, 250 to 260 range, and feeders kind of got some coiling. Kind of the same story. That 172 to 178. In fat cattle, it just can't decide what direction it wants to go. I think if we get over some of those levels, if we can get over 180 in August fats, that's going to be very, very bullish as far as the technicals go. And same thing, if we push down below 170, that's not a good story. So the best thing I can tell a producer in here, if you're worried about it, if the last couple of weeks have given you heartburn, come in, buy some puts, buy LRP, put something underneath this thing, and then we'll sit back and see what happens.
One other quick thing too that I just thought about, I haven't touched on this in quite a little while on the show, feed needs here. I mean, if you didn't lock in some cheaper corn a few weeks ago before this rally, and you need feed, or you have to bite the bullet here, can you maybe wait a little bit? What's your thoughts on that side of the equation?
Longer term, we're pretty bearish the grain markets. We're pushing customers to actively do something on the production side to hedge, buy puts. In that same token, there's drought risk right now. So, if I'm a cattle feeder and I'm sitting out there trying to lock in feed needs for the next year, I might want to look at some type of a $5 call strategy. Maybe a call spread over the top. Maybe I pick a spot where I'm comfortable buying it lower and sell a put down there in order to cheapen up that cost of that call. But definitely something to look at here to protect ourselves from something popping up this summer. If it does turn dry, that's not a good recipe to have a really wet spring, and a lot of places have to mud this crop in. Weather turns dry. That's not a good recipe for a big corn yield, and that would be very bullish to the corn prices. So if I'm a cattle feeder, it's probably something I want to look at. If I'm a hog feeder, I'm probably looking at some type of strategy that limits the upside if the market does go shooting higher, but allows me to buy it cheaper. We're going to stick right now with what we know, and what we know is probably going to put 90 some million acres in the ground. And given the last few years, we're probably going to grow 175, 176, 177 on a national yield. And we don't really have a big story there for corn as far as pushing prices higher. Now, like I said, that's what we know right now. It might change in a couple of weeks. So we need to be fluid, and we need to have some type of strategy that's a little bit flexible.
Always enjoy the conversation. And I know if folks need help with their marketing strategies that we've been talking about, they could find you guys very easily. Agmarket.net. Give you a call, 844-4AGMARKET. With that, Tyler Schau. Always good to talk with you, buddy. Thanks for joining us on Market Talk. Have a great week. We'll talk to you again soon.
You bet. Take care, Jesse.
Tyler Schau there with agmarket.net. That's going to do it for the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@markettalkag and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.